Welcome everybody, and today we'll discuss about section 43B. Yes, there are certain items which are mentioned under section 43B, and for that items you can claim deduction only on actual payment basis. Now you pay through account pay check, electronic clearance system, you pay through demand draft, you pay through something called as electronic mode. Okay, but only when you actually pay it is allowed as deduction. If it is less than 10,000, even in cash. So section 43B gives you the list of items which are allowed as deduction only on actual payment basis. Right? Now, what are that items? Before that, I'll just ask you a question. Suppose 43B says that items are allowed as deduction on actual payment basis. Now tell me, suppose if this list item which we will discuss, there are 8 items totally. If any one of them is due, can we claim deduction? The answer is no. If it is actually paid, then only allowed as deduction. Sir, we are following mercantile basis of accounting. Doesn't matter. What the law says here, notwithstanding anything contained in any other provision. That means whatever is explained in any other provision doesn't matter. For these items, only actual payment is the criteria. Come to the first item. The first item talks about any tax, duty, fees and cess. Now when I speak about tax, it is not income tax. Please remember. Okay. There are certain tax which we pay to state government also, like professional tax is there. Right? Entertainment tax is there. Property taxes are there. Right? Duties like custom duty is there. There are certain cess which are applicable. Now cess here doesn't mean health and education cess. Right? Health and education cess is disallowed. Please remember. Okay. Any fees which we pay to Ministry of Corporate Affairs for company filings, or you pay to any law, right? Under any law you make the payment. That will be allowed only when actually paid. So what I said, first item, section 43B, first item, tax, duty, fees, cess, allowed only when paid. Now you may ask me a question, by what time we should pay? Of course, in the previous year. Sir, थोड़ा extra time दे दो ना. Okay यार, I'll give extra time. Till the filing of income tax returns, at least you should make the payment. So, previous year related any such expenditure like tax, duty, fees and cess, you pay either in the previous year or at least till you file the income tax return. Till the due date of filing the income tax return, if you make the payment, you can claim the deduction. Clear? Sir, but under section 30 to 37, it is already claimed as deduction. But this 43B overrides all that sections. So there, of course, you should qualify that section 30 to 37. But this is additional and this is more powerful. Okay. So tax, duty, fees, cess. What is the rule to remember? Pay in the previous year or before filing returns to claim deduction. Second point, bonus. Generally bonus is paid to employees, right? Some commission also may be paid to sales workers who are into sales to motivate them. So if bonus or commission is paid, that is also allowed as deduction only on actual payment. Now section 36 says bonus and commission is allowed, but section 43B puts additional conditions. Okay yaar, allowed, but actual payment basis. Okay. Now third point you come to. Generally for business we take loans, correct? and on that loans we pay interest also. Now basically what happened, if you take the loan from public financial institution or maybe state financial corporations or maybe state industrial investment corporation. What is public financial institution? Like life insurance corporation, LIC is there. Second one, state finance corporations. Third one is state industrial investment corporation. So if you take loan from any of the three and you have to pay interest on that, interest is allowed as deduction, no problem with it, but only on actual payment basis. Sometimes you don't get loan from this type of institutions, so then you go to NBFC, non-banking finance companies, like you go to Bajaj Finance, Tata Capital, right? Then what will happen in this case? The government clearly says that if you take a loan from, there are two types of NBFCs. One is deposit taking NBFC, right, which accepts deposits from the public. Deposits means not savings bank deposits, right? They accept fixed deposits from the public and they pay good interest also. Like if you do in Bajaj Finance at least 5 years FD, you will get around 8.5% interest. So Bajaj Finance is a deposit taking NBFC. Now, second type of NBFC is systematically important non-deposit taking NBFC. Now these NBFCs can lend you money, take interest on it, but they cannot accept deposits, FDs, fixed deposits from you. Now, there are many NBFCs in India, but not all NBFCs are systematically important, right? If an NBFC has at least 500 crores of assets, right, on the asset side of the balance sheet, the worth should be at least 500 crores. First point. Second, the NBFC should be approved by Reserve Bank of India. And third is they are not accepting deposits. If all these three are satisfied, then such NBFC will come under systematically important non-deposit taking NBFC. What are the three things? First, they should be approved by RBI. Second one, as per the last audited financial statements, their assets should be at least 500 crores. Third thing, they don't accept something called as fixed deposits from you, right? So if this NBFC or systematically important non-deposit taking NBFC, if you are paying any interest to them, that is allowed as deduction only on actual payment basis. Now come to the next point. If it is a scheduled bank like Union Bank of India, State Bank of India is a scheduled bank, or it is a cooperative bank, like there is a Deccan Cooperative Bank. Okay, so if you are taking any loan from them or advances from them and paying interest on that, you will get the deduction only on actual payment basis. But please remember that primary agricultural credit society, or primary cooperative, agricultural and rural development bank are not covered here. So primary agricultural credit society or primary cooperative, agricultural and rural development bank are not covered. What does this mean? So this means that in the case of primary agricultural credit society, if you take the loan from them, or if you take the loan from primary cooperative, agricultural and rural development bank, if the interest is actually due, also you can claim the deduction. Okay, generally if you take from scheduled bank or if you take from cooperative bank, the deduction is allowed only on actual payment basis. But if it is primary agricultural credit society, if it is primary cooperative agricultural and rural development bank, then even if the interest is due, you can claim the deduction. Clear or not? Very good. Now, till now we understood many things like tax, duty, fees, cess, bonus, commission, interest from when we take the loan from public financial institution, state finance corporation or state industrial investment corporation, or when we take the loan from NBFCs, deposit taking, systematically important non-deposit taking, right? Scheduled bank, cooperative bank, other than the two we discussed, right? Now come to the next thing. Sometimes employees work even on holidays, so they get something called as leave encashment. So to the credit of the employees, if there is any leave encashment left and such leave encashment employer pays to the employee, so actual payment is important. If the employer pays the money to employee, then only he will claim the deduction. So employer pays to employee some money. Why it is paid? Because there are some leaves to his credit which the employee want to encash, right? Then it is allowed to employer not on due basis, on actual payment basis. Next thing, sometimes or every employer who satisfies or cross certain limits has to create something called as provident fund, superannuation fund, gratuity fund, ESI fund, any other fund for the welfare of employees. Now employer should contribute to these funds, pay the money, and when employer actually pays the money, then only he will claim the deduction. Now suppose if employer don't pay the money, then he has to pay penalties under these laws also. But to claim deduction under this income tax for these funds which the employer contributes to the benefit of employees, he should pay the money, then only he will claim the deduction. Pay the money before filing income tax returns. So again repeating for you, employer's contribution for the welfare of the employees in the funds called as provident fund, superannuation fund, gratuity fund, ESI fund or any other welfare schemes, allowed on actual payment basis. Now come to the next point. Sometimes we use railway assets. Now when we use the railway assets, for that we make the payment, and when we make the payment, that payment is allowed on actual payment basis. Suppose if it is due, you did not pay to railways, but the expenditure is still due, can you claim deduction? No. Actual payment basis. There are many companies or organizations which create tea stalls, some shopping type like Cave Coffee Day, I saw it railway stations. There are many stalls, right? Some sell some groceries, some sell some other products, but there are many things as such. So they all have to pay rent to railways because they are using railway property. So their payment is allowed as deduction only on actual payment basis. If actually not paid, no deduction. Okay, clear. Now come to the analysis part. Now whole things we discussed, but what we learnt out of all this? 8 points we completed till now. The important things to learn is the payment should be done before the due date of filing returns. If any expenditure is outstanding till the date of filing returns, no deduction allowed. Second point in the analysis, you strike it off. It's not important at all. Not actually will confuse you in the long run. So method of accounting is irrelevant. Cut. Okay. Whoever are going to get books in further, new books will be printed, they will get this without this line. But at least for those who have books, please, method of accounting is irrelevant. Cut that point. Okay. Now 43B talks about something. But you should think in a sequential manner when you think about 43B. First, is the expenditure allowed under section 30 to 37? If the answer is yes, is there no disallowance under section 40 or any other section? Right? Disallowance may be there, right? So no disallowance? Yes, there is no disallowance. So expenditure is allowed under section 30 to 37 and there is no disallowance under section 40B or any other section. Then only we will apply section 40B. Right? Now, for you to tell me, personal expenses are there. Personal expenses are not allowed as deduction under section 30 to 37. So if they are paid also in the previous year, or if they are paid even before due date of filing returns, doesn't matter. You cannot claim deduction because first test itself it failed. Right? Now, income tax is an expenditure for the business. Correct? Now, if you see, it is general business expenditure only. So maybe section 37 will allow also. But what happens? Section 40 disallows it. Right? Section 40 says income tax is disallowed. Now when income tax is disallowed, whether you pay it in previous year or before filing returns, can you claim income tax as deduction by quoting section 43B? The answer is no. You cannot claim deduction of income tax by quoting section 43B. So that's why this point is very important. First check whether it is allowed under section 30 to 37. If the answer is yes, is there no disallowance for this item? If the answer is yes, under any other section. If these two answers are yes, then check 43B. If 43B conditions also satisfied, then no problem, you claim the deduction. If you fail section 43B, then disallowed. Okay, very good. Now before filing returns, arey yaar, when to file the returns? So section 139 answers it. Section 139 says if you are under audit, right, your books of accounts should be audited by a chartered accountant. Then 31st October of the assessment year is the due date. Now your previous year is 2020 to 23. Assessment year is 23-24. So what is the due date for filing income tax return if you are if you are an audit assessee? Answer is simple, 31st October 2023. Suppose you are not covered under audit, then simply 31st July 2023. Okay. Sum payable means which is actually due. Liability is there. That is sum payable. Okay. Very good. Now there are some 5 important points. Now, देखो, one way lecture is always possible and we are continuing anyhow. But shall we play together? I'll ask questions. You try to give answer. And we will study these points also. So 5 points are there. Right? Regarding each point, I will ask question and then explain the point. Meanwhile, you also analyze with me. Right? Okay. Now under section 145, method of accounting, whatever you follow, like if you follow cash basis of accounting, then business pgbp income should be computed as per cash basis. If you follow accrual basis of accounting, then pgbp income should be computed on accrual basis. Correct? We discussed this. Now the question is, section 43B will apply in both these cases, that is if you are following cash basis and accrual basis, or only in case of accrual basis? Now think and try to answer. The right answer is accrual basis. If you are following accrual basis of accounting, and for computing business income also accrual basis is followed, then 43B you should check. Okay, payment should be done before filing income tax returns. But if suppose you are following cash basis of accounting, then the payment should be done in the previous year itself. Then only you can claim the deduction. So 43B will not apply. So if you are following cash basis of accounting, because you can claim deduction only if paid in the previous year, you 43B will not apply. So what is the conclusion? That note number 1 will say simply accrual basis if you follow in your accounting and business income computation, then only 43B, right? And you have leverage to make the payment for certain items till you file the income tax return. But if you are following cash basis of accounting, then 43B not at all important. You can totally ignore 43B and you can claim the deduction of items only if you actually pay it in the previous year, right? Then you need not check even the date of filing the income tax returns if you are following cash basis. Okay. Second question which I have, please remember this question is super interesting also. We said that you can claim the deduction before, if you make the payment before filing income tax returns. This point seems to be wonderful, correct? But this point is applicable only in the when the first time the payment has become due, or whenever you make payment, in all situations this point is applicable. I feel you understood the question. Suppose example, you have to make the payment of, suppose, interest on loan. Interest on loan should be paid in 2020-23. Interest on loan you are paying to LIC, public financial institution. So in this case you have to make the payment before filing the income tax returns. That's okay in the 20-23 previous year. But if you delay in making the payment, you did not make the payment in 22-23, which you should have made. You paid in 23-24 or 24-25. Will the condition of filing the making the payment before filing income tax returns applicable? The answer is no. If suppose 22-23 the payment is due and you make the payment before due date of filing the returns, then okay, you can claim the deduction. But you defaulted in 22-23, you paid in 23-24, right? And that too after filing returns, then definitely you will get deduction on actual payment basis. Chalo, let me make you simple. Suppose I have a company called as GNC Educare, right, where I record classes, sell classes, all that, you know, anyhow you purchase, right? So what happens in this case, suppose example, I make certain payment like interest on loan. Suppose I took loan and I am paying interest on loan to State Bank of India. Now 22-23 previous years related interest is there. I should have made the payment by 1st March 2023, but I did not do. I defaulted. I paid on 1st June 2023. No problem. Arey yaar, before 31st October 2023, right? I can claim the deduction in 23-24 assessment year itself. But suppose the 1st March 2023 payment or 1st October 2022 payment I did not do till 31st October 2023. That is before the due date of filing returns for my company. So I actually made the payment on 1st December 2023 after filing returns. Now what will happen? then actual payment will be considered. That means 23-24 the actual payment is done, right? So 24-25 assessment year I can claim the deduction. The previous year of payment is 23-24 and the assessment year for claiming the deduction is 24-25. Correct? Right. So first time you get the privilege. If you default, don't pay till filing of returns, then later on actual payment basis only. Okay, clear? Yeah. Many years there was lot of dispute between taxpayers and the government, which has been put to an end in this year. And this is an amendment. That's why I underlined it. You see, third point. Like there was interest on debentures. Now company is not able to pay. So what they did, they converted the interest into again further debentures. Now the company want to claim it as deduction by saying that we actually paid. Is it actually paid? Arey, you did not make cash payment, right? So the government gave a clarification, and that's note number 3. And this can be a case study question in your exams also, that if you are converted interest on debentures into debenture or interest on any loan into further loan, the interest will not be considered as actual payment. Okay, right. Come to the fourth point. Suppose you claimed certain expenditure as deduction on accrual basis. Now later on you made the payment. Can you claim the deduction on payment basis again? Sir, 43B, sir, payment basis you can claim. Sorry. Right? When you claimed the deduction on accrual basis, you cannot claim it as deduction on payment basis. Simple criteria is you can claim deduction only one time. Okay? Right. Now, suppose employee actually contributes to the provident fund, superannuation fund, gratuity fund, ESI fund or any other welfare schemes. So from employee's salary, employer deducted the amount. Legally he is authorized, he did. It will be treated as employer's income because he has the money with him, right? The money belongs to employee because employer deducted from the employee's salary. Now employer holds the money. So you remember that it is income to the employer. Now as per the respective law, if employer deposits the money in time, then employer can claim deduction under section 36. If suppose employer delays, then he will not get deduction at all, right? So employer should strictly comply with the laws, otherwise he will have to heavily pay unnecessary taxes. That's what the government's intention is. Provident fund, gratuity fund, ESI fund, all these are for goodness of the employees, right? So employer should deduct the tax, deduct the amount from employee's salary on time and deposit as per the respective laws on time, right? If he deducts, it is treated as income for the employer. And if he pays to the government on time, no problem. He will claim deduction under section 33. Nullified, right? First it's treated as income, minus now it is treated as expenditure, no problem. No net income, so no extra tax. But if he don't deposit in time, then he will not get deduction and unnecessarily he will pay the extra taxes. Now if he later on makes the payment to the government, then also he will not get any benefit. So the principle is very clear, it's now or never. Okay. So देखो, there are two contributions. One is employer's contribution, which we discussed in the 7th point, right, in 43B. That is very simple. You pay before filing income tax returns, that's enough. But when you touch employees' money, that is employees contribution you take, it is treated as income, and when you actually pay before time or on time, then you claim deduction. But if you fail, then you are doing the biggest mistake. You will not get deduction even if you pay later on, and you cannot escape payment too, right? You will be caught under the EPF Act or ESI Act or under the gratuity fund related laws. Even jail may happen. Such strict conditions are there. So if you cannot avoid payment, depositing with government, do it in time so that you will get the deduction. So section 43B over. Come to section 41. Most of the things in 41 I already discussed, so we will not waste much time on it. 43B talks about income, deemed income. So in pgbp there are two income related sections. One is section 28, we discussed at the start, right, in the first lecture, and second one is this 41, this deemed income. Now what is 41 subsection 1? First let us discuss 41 subsection 1. Suppose if you recovered certain money which you actually claimed as deduction, like some loss is there, like I'll give you example, loss is there, expenditure is there, or trading liability is there, which you recovered directly or indirectly. I'll tell you how it works. Suppose you have a lot of stock, you did the insurance of stock. What happened? That the whole stock was destroyed. Now what you did, you claimed the deduction for destruction of stock under section 37. Now you got the deduction, right? But later on you recovered the same money from insurance company. Now recovery against the deduction, so it is taxable under section 41 subsection 1. Same way for any expenditure also, right? And third one, trading liability. What is this trading liability? Suppose example, you actually purchase certain goods from any store, right, from your supplier, he gave goods on credit, and later on what happened, the supplier said you need not pay the money, right, he waived off your liability. So if such trading liability is waived off, then whatever deduction you claimed, dekho, I will tell you, trading liability means what? For goods only, right? You purchase suppose 1 lakh worth goods, you will show purchases as expenditure and claim deduction, yes or no? Now that 1 lakh you claimed as deduction, but now what happened, you need not pay that 1 lakh rupees. So whatever you need not pay, right, the remission happened, or the seller supplier said that I will omit this liability, then that 1 lakh becomes your income, taxed under section 41 subsection 1. Come to section 41 subsection 2. This is balancing charge. Array, you remember power generating units, electricity units. I said, you remember that if the asset is sold, you remember this, that if sale price is more than the WDV, there is a balancing charge, that is business income. We computed problems also on that. That is what section 41 subsection 2 is. Okay. Now come to the third point, 41 subsection 3. Sale of scientific research assets. Now here there are two parts. One, scientific research asset was used for some other purpose and then sold, is not covered here. Scientific research asset not used for any other purpose, only used for scientific research only, and then sold, that is covered under 41 subsection 3. Array, you remember that your sale price or the deduction claimed, whichever is lower is your business income, you remember. sale consideration of the asset or deduction claimed, whichever is lower will be treated as business income, yes or no? That is your pgbp income under section 41 subsection 3. Anything more than the original cost, sale consideration more than original cost, is your capital gain, right? That's what are there. Chalo, come to 41 subsection 4 now. Recovery against bad debts. Now we know that bad debts are there. So bad debts you claimed as deduction under section 36. Now you recovered, correct? So when you claim a deduction, now you got the money, it is taxable. That's it. Now regarding this, there are a lot of adjustments in your problems. If suppose they give you P&L account and in the adjustments they give you bad debts recovered, right? It is not forming part of P&L account. In the adjustment, additional information they gave you, recovery of bad debts. What will you do? Simply add for computing the business income, right? Add such recovery to net profit to compute your business income. But the blunders happen when if recovery of bad debts are given in P&L account itself. Here you have to be extra careful, right? How much recovery is taxable you should check, and how much is credited to P&L account you check. If both are same, no problem, ignore. But if suppose P&L account amount is more, then what recovered bad debts are taxable? Suppose recovered bad debts are 10,000, which is taxable. In P&L account they gave 15,000 recovery of bad debts. Then what will happen? That extra 5,000 which is shown in P&L account should be deducted. Simple as that. Now I'll tell you one more thing. Sometimes what happens, you want suppose 1 lakh as bad debts. Income tax allowed only 80,000 as bad debts. You recovered, suppose later on, suppose you recovered around 60,000 you recovered. Oh sorry, 70 I'll tell for easy. Now 1 lakh you showed as bad debts, but income tax allowed only 80,000 as bad debts. Now you recovered 70,000. Should this 70,000 be taxable? The answer is no. In this 70,000, you will simply say 1 lakh minus 80. 20,000 was good debts, right? That I recovered. So why should I pay tax on that? So 20 is not taxable. So out of 70, 20 is not taxable. Balance 50, I felt it is bad, so I claimed as deduction in income tax, and now I got it, so let me pay tax on it, right? That's what section 41 subsection 4 teaches you. Come to the next point. 41 subsection 4a. Hey, we discussed in section 36 in detail about this. Financial corporations who basically give loan to infrastructure capital companies, infrastructure funds, right? Now when they give loans, such financial corporations, every year some amount they keep it as special reserve. Now when they create special reserve, they get deduction under section 36. When they withdraw that amount from special reserve, it is taxable under section 41 subsection 4a. Last thing to remember, that suppose you say that, sir, my business is discontinued, now I recovered the money, why should I pay tax? Business itself is not there, why should I pay tax? Government said because section 176 subsection 3a and subsection 4 says that you should pay tax on. Suppose you had a business, in that some customers did not pay the money, you closed down the business, now you recovered the money. What will happen? Now you should pay tax on that. Sir, father's business, now son is continuing, should son pay tax? If son can recover the money from customers, why he should not pay tax? Right? So recoveries in relation to discontinued business also taxable under section 176 subsection 3a and subsection 4. This way we completed section 41. Hope all of you enjoyed it, right? There are certain miscellaneous topics which we should complete, so I feel we'll complete in this video itself. Okay for all of you? Right. Method of accounting in certain cases. When I wrote my CA inter exams, I'll tell you what happened. I was writing income tax paper and I got a question. I did not study that, but the question was so easy. For 4 marks, I jumped onto the table and wrote the answer. What was the question? They gave you stock A, B, C, D, E. They gave cost of A, B, C, D, E separately and net realizable value of A, B, C, D, E separately. And then they asked in the question, what is the value of stock? Wow. In accounting, at least I know that inventory should be valued at cost or net realizable value, whichever is lower, correct? Cost or net realizable value, whichever is lower. Same thing we study under ICDS 2 on valuation of inventory. ICDS is for income tax. Okay, ICDS is nothing but accounting standards for income tax. Okay. So that also says the same thing. So I got it and I cleared the exams with ease. So simple question, it may be asked in your exam. Okay, one numerical problem, maybe for 4 marks, maybe for one MCQ mark. What is it? Inventory should be valued at, or stock should be valued at actual cost or net realizable value, whichever is lower. Now come to second point. Second point, which it says, sometimes what happens that when you actually purchase some inventory or when you give certain contracts, so not only the price has to be paid, but some taxes also has to be paid, some additional fees has to be paid, some additional transportation charges may also be paid. So if you are paying anything in addition, you have to add to the cost. Okay, if you are paying something in addition, you simply have to add to the cost. That's it. Come to the third point now. Third point is very simple. It talks about securities. Now securities means, please remember, shares are called as securities. Bonds are called as securities. Debentures are called as securities. There is a big definition, but in short I explained. Now, if the securities of a certain company is there, that company is not listed in a stock exchange. Suppose take my company only, GNC Educare OPC Private Limited, not listed on stock exchange. Okay, so for my company or any company which is listed in the stock exchange, right, but the shares are unquoted. Now what is unquoted? Because there are two types of shares in a stock exchange. One which are regularly traded, right, and second one which just keep aside, no much trading happens. So if some shares are there which are regularly traded, bought, sold, they are called as quoted shares on the stock exchange. And which are not regularly traded, whose price is not shown on the stock exchange, they are called as unquoted, right? Unquoted shares. Now remember, I am talking about two types of companies. One which is not listed in stock exchange, like my company. Second one is listed in stock exchange, but prices of shares are not quoted. For these two companies, what should be the value of securities? The actual cost. The actual cost. That's it. For all other securities, all other means what is left? That which is traded on stock exchange are left. So for all other securities, it is quite simple. You should take actual cost or net realizable value, whichever is lower. Actual cost, or for Reliance, what you should take? Actual cost or net realizable value, whichever is lower. Right? Now, there may be some scheduled banks, there may be public financial institutions. Now, what about the securities of these? What about the securities of SBI? What about the securities of LIC? So the answer is, for these securities also follow ICDS. So whatever we did in point number 3, right? Same you should do for the securities of scheduled bank or public financial institutions. But you should also comply with Reserve Bank of India guidelines. Right? Now, one more thing I have to tell you, that when you do the actual cost or NRV, whichever is lower calculation, how you should do? In lump sum or category wise? Right? All shares you did total, right? And then you are comparing. No, it is not right. What is right? Category wise. Each category separately you should calculate actual cost or NRV, whichever is lower. Okay? Category wise it is done. So in your exams you may get some other words, right? Should we do section wise? No. How you should do comparison? Category wise. Right? This is what you should remember. Now, if you want to know more about securities in detail, right? Some extra knowledge you want, practically you want to understand, you just refer to my ICDS on securities, which is listed on YouTube. Okay? If you see there, you will practically understand. But as of now, this information is more than enough. Right? Shall we go to the next thing? There are certain incomes like interest on compulsory, okay, government compulsorily acquired your property. Now government has to pay compensation, but government to government hai, it paid late. When they delay in payment, they not only pay the compensation but they also pay interest on that. So how to tax the interest on compensation for compulsory acquisition of property? The answer is simple. It is taxable under income from other sources. Right? Where it is taxable? Income from other sources. It is taxable on due basis or receipt basis? The answer is, when actually received, it is taxable. How much is taxable? Simple. Whatever compensation received minus 50%, balance is taxable. Suppose you received 1 lakh, deduct 50,000, that is 1 lakh into 50%, and balance 50,000 is taxable. That's it. Okay? I gave some more information from other sources chapter. No worries. Okay? Shall I go to the next topic? In other sources, again I will discuss all this. Okay? As of now, in theory I wrote that it is taxable on actual receipt basis. In other sources, I'll write all this. When it is received, it is taxable under other sources. 50% standard deduction should be deducted. Balance, it is taxable, I'll teach under other sources. There are certain export incentives. Government gives lot of incentives to you if you are into export business. PLI scheme, production linked incentives. Because देखो what happens, if government gives you incentive only for setting up the business, then you will take the money and sleep. But if government says you do production, then only will give incentive, then definitely you will produce. So for producing you spend some money, so you'll always love to sell it. So that's wonderful scheme. So export incentives if you are getting, or if there is any price escalation means increase in price of some contracts, so that is taxable on a reasonable basis as and when the income becomes certain for collection. Ultimate certainty of absolute collection, right? If you become certain that you will be able to collect the money, then it is taxable income. It should be taxed in that year, right? Next thing, subsidy. Now you call it as subsidy, you call it as grant, you call it as something called as subsidy, grant, waiver, whatever name. But ultimately, if it is not taxed in the year of accrual, when it is due, it is not taxed. Then it will be taxable when actually received. Okay. If in the year of accrual it is not taxed, it is taxed in the year when it is actually received. Clear? Very good. Now there are some more miscellaneous topics which we have to complete. Hey, if it is a construction contract or service contract, what to do? So how to decide your income? For that, the answer is quite simple, straight answer, and that is percentage of completion method. Suppose example, you have taken a contract to construct an apartment for suppose 10 crore rupees, and it will take suppose 3 years time to complete. So you will not divide the 10 crores income by 3 years, but what will you do? The engineer is appointed, and engineer will fix certain levels, that okay, up to this thing completed, we'll consider this percentage complete. Now on the percentage completion method, the income should be determined, right? And how percentage? Engineers will assign the percentage, right? Sometimes contracts are very small, less than 90 days or up to 90 days. Then the law is very clear. They say that once you complete the project, you determine, you consider it as income, right? 90 days is reasonably short time. Once the contract is completed, work is done, then you realize the income or you consider it as income. But if contract has so many indefinite things, many things to do, then on a straight line basis, you consider the income, calculate the income. Now, while you compute the income in the contract price, should you consider the retention money? Suppose if it is 10 crores contract, they will not pay you 10 crores at a time, right? If suppose you completed 30% of work, they will not pay you 3 crores upright, correct? What they will do? They'll pay something around 2.4 crores and they will retain balance 60 lakhs. So what is your income? Your income is 2 crores 40 lakhs or your income is 3 crores. So the answer is 3 crores. So your income includes retention money, right? Now, what about expenditure? Now, whatever you incurred, that is your expenditure, as simple as that. But during the construction, you will sell certain scrap, certain assets. Now, you may earn certain income also. So, from that expenditure, will you reduce that expenditures? Like some money was required, not required now, you kept in bank, you got interest. Or you invested in shares, you got dividend. Or you sold certain assets, you got capital gain income. Should you reduce it from the expenses and take the net expenses to compute the income? The answer is no. For computing the income, don't deduct all these expenses, sorry, incomes. So from the expenditures, if you get some interest income, dividend income or capital gain income, please don't deduct it from expenses. Now in accounting we do the same. In accounting it is clear. From the expenses we'll deduct related incomes and net expenses we show. But if you come to income tax, your interest income, dividend income is taxed under other sources chapter. Capital gain is taxed under capital gain chapter. So that's why, and construction contractors income is business income. So that's why you should not deduct from the expenses interest income, dividend income or capital gain income. Clear to all of you? No doubt should be there, right? Now, the last topic which is important for you to study is undisclosed incomes, unexplained incomes. How to tax it? Will government tax it? Because thief is not a thief till he is found, correct? Same way, if you liberally declare your income, then government, you calculate tax, you pay, perfectly right, and this is the right way of building a strong society. But there are many people who want to escape taxes, so they find some or the other way. They don't show the incomes, right? There are many expenditures, so they try to escape. So government catch hold of them and tax them in the year in which government catch them. So there are some 5-6 cases which we'll discuss one after the other. First case, cash credits. Now what are cash credits? If you take literal meaning, a credit entry in your books. A credit entry in your books. Right? Now you purchase the goods from the supplier. Supplier gave you some credit. Now you showed the purchases, credit purchases. Now that is, you can claim it as deduction. Right? And you will show the creditors as liability. So something like this, cash credits are there. Now government asked you explanation that okay, these cash credits are there, but from when, from whom you took, who is that person, and you are not able to give answer to that. If you are not able to give answer, you are not giving answer, or your answer, your explanation is not satisfactory to the assessing officer, then the cash credits are taxed under the income tax. Okay, they are taxed. Same way, there are two more items which I'll talk about here. Suppose share application money is there, or share capital money is there, right? Or share premium money is there, or I'll even add that somebody gave you loan, so you showed a loan entry, right? So share capital money, share application money, or share premium money, or loan related money are shown on in your accounts. Income tax department asked you, "Arey, from where this money has come?" You are not able to give proper explanation. Then government caught these people whose names are mentioned in your records as the shareholders or as the lenders. Income tax department asked them also. They are also not able to give satisfactory explanation. If neither you are able to give explanation nor they are able to give explanation, then what will happen? The amount becomes taxable income for you. Why people are not able to give explanation? You only think. If it is black money, they are not able to give explanation. If it is criminal money, they will not be able to give explanation. Right? The so-called Khans, Shah Rukh Khan, Salman Khan, Amir Khan, or any other Bollywood actor getting money from Dawood Ibrahim for producing movies, if government properly ask them, will they be able to answer? हाँ, ये तो दाऊद का पैसा है सर जी, ऐसा थोड़ी बोलेंगे यार. Think about Amir Khan's movies get lot of revenue from China. They become super hit movies in China. And he earns some 100, 200, 500 crores from China. Is it practically possible? No other Bollywood movie or Tollywood movies are earning from China, but Amir Khan's movies earn. Is it practically possible? So anyhow, this earning part, if they are showing it as income, then it is not covered under this discussion. Okay, right? They are showing some income which is not genuine. Government income tax department at least is not bothered. But if you are showing some cash credits, right? You are showing it as loan, you are showing it as share application money, you are showing it as share premium money, and you don't have explanation, you don't have answer from where the money came. The shareholders, the lenders were invited, they don't have explanation. Then it becomes a taxable income for the company, for the person in whose books of accounts it is, and no satisfactory explanation is given. Clear? Any doubt? No doubt. Correct? But if suppose you took the money from venture capitalists, then government says, okay. If it is venture capitalist, we will only ask you. If you are not able to give proper explanation, we will consider it as your income. Venture capitalist, government says, we will not ask them. Right? So explanation will be not sought from venture capitalists. If it is a lender like SBI, then explanation may be sought. If it is a private lender of yours, explanation will be asked. But if it is venture capitalist, they will not ask explanation to venture capitalist. It's your explanation which matters. If you are able to explain properly, rightly, then no problem. But if the explanation given by you is not satisfactory, or you are not ready to give explanation, then income tax department will consider that fund, that cash credit as income and will tax. How much is the tax rate? I'll tell at the end, don't worry. Now come to section 69. 69 talks about unexplained investments. When government was doing your assessment, the income tax officer was shocked. My God, this person has 500 acres of land. My God, this person has investments in US stock exchange of 500 billions. My God, this person has investments in so many shares of Ambani, Adani, Tata, Birla, Wipro. Oh my God. They were shocked. And they asked you explanation. How did you get so much money? And you don't have any answer to give. Right? There are many politicians in Telangana in top positions. When their real estate details will be opened, they will have no explanation to give. Right? So basically what I wanted to convey, if you are not able to give explanation, not giving explanation, then it would be treated as your income and will be taxed. Clear? Unexplained investments. Investments may be in real estate or in properties. Or in shares or debentures. Right? General explanation. Now come to section 69A. There is one Bollywood director called as Anurag Kashyap. When income tax department raided their property, they found 5 crores rupees cash. That's not enough. 500 crores worth bills, cash invoices. Now when Anurag Kashyap was asked, where did you get the money from? He don't have any explanation. There are many people coming from Saudi Arabia, Dubai countries to India. and bricks of gold यार, क्या बात करते हो? Bricks, 1 kg gold brick, and they are bringing to India. Government asked, अरे कहाँ से लाए हो भाई, कहाँ से कमाए हो? From where did you earn so much income? No explanation. So such unexplained money or bullion, jewelry or any other precious metal like gold bricks, if no explanation is given or explanation given is not sufficient, then the money is taxed under section 6. Taxed. It is taxable income under section 69A. 69A. Okay. Same way, unexplained expenditure. You have marriage at your house and you spent 100 crores on marriage, the lavish marriage function of Hyderabad. Income tax department will not do anything till the marriage is over. Because in your income tax returns you showed your income is just 6 lakhs rupees and you paid just a nominal tax. Or even less than 5 lakhs you paid nothing. And for marriage you are spending 100 crores. You are booking the best function hall. The boy is coming through helicopter, right? So much tamjham, right? Showcasing of their wealth happened on the day of marriage. Then one day finally income tax department will call all your family members and in separate rooms suddenly they will be asked to sit. Every income tax officer will harshly ask you from where you got the money. And if you are not able to explain or you don't give satisfactory explanation, all that expenditure which is unexplained will be treated as income. So we understood section 68 cash credits, section 69 unexplained investments, section 69A unexplained money, section 69B unexplained am I right, unexplained expenditures. Okay, if I am wrong with, okay, unexplained expenditure actually will come later on, but section 69B talks about unexplained investments and money bullion jewelry. If you are showing something but not showing totally, many people do this. You have gold of 10 kgs with you and you just show 1 kg. Government caught. Section 69B will be attracted. Okay. And government will ask you to pay tax on unexplained the gold or investments, whatever it may be. Many people do. What they do is, when they spend the money, they show it as expenditure, but they don't show it as asset in their balance sheets. So their government catch them, right? So this type of things government will catch and it would be taxable under section 69B. Section 69C also talks about unexplained expenditure. I forgot it, I wrongly quoted the section. 69B is for investments and money and bullion and jewelry, which is partially showcased to the government income tax department. Section 69C talks about kya yaar, expenditure. Okay. Now, section 69D. Section 69D talks about what? D talks about if you have borrowed money or repaid the money through hundis. Hundis are nothing but traditional bills of exchange. So if you have borrowed money or repaid the money on hundis and when government asked you explanation, you are not able to properly give the explanation, then government will tax your income. Only one thing government will ensure is that when you repaid the loan, again it will not be taxed. So now because government got some hundis which you did not showcase to the government, you did not file or give details in your income tax returns, government taxed it. Okay, again on that further transaction happens, should government again tax it? Government said no, we are not so cruel, will not tax. All of you may be interested to know, sir, what is the tax rate? Chalo, before I go to the tax rate, I'll repeat for you. Cash credits is covered under section 68, investments are covered under section 69, and 69(8) talks about money, bullion, jewelry. 69(b) talks about partially investment money, bullion, jewelry, which are not disclosed. 69(c) talks about expenditure. 69(d) talks about hundis. To all these words you add unexplained. Okay. Now what is the tax rate? 60% is the rate of tax. Don't worry, 25% surcharge compulsory. Then 4% health and education cess is waiting for you. So what is the rate of tax? 115 BBE. What is the rate of, what is the section number? 115 BBE. What is the section number? 115 BBE. And what is the rate of tax? 60%. Surcharge 25%. Health and education cess 4%. How much it comes to? I'll show you. Suppose example, your income, which is your cash credits or unexplained expenditure, all that comes to 1 lakh rupees. Government caught. When they caught, 1 lakh is your income. Now, okay. Now, income of which year? The year in which government caught you, income tax department caught you. Okay. Now, on 1 lakh, 60% tax. So 60,000 will directly go to income tax. 25% surcharge. So 60,000 into 25% will come to 15,000. So 60,000 tax plus 15,000 surcharge. Because surcharge is always calculated on tax. Okay. Right. So 15,000 surcharge. So 75,000 will come. Health and education says 4%. So it will come to around 3,000, I feel. 75,000 into 4%. 3,000 will come. So 75,000 plus 3,000. 78,000 will be your tax. So if you try to not show your income, try to hide your income in the name of investment, in the name of expenditure, in the name of cash credit, in the name of something or the something, you have to pay 78%. If you lawfully show, then you will pay around 30%. If you are caught, then 78%. And one more dangerous situation, I'll tell you what will happen. There is one doctor which I know, which I heard the news. What he did is, he was collecting all the fees from clients in cash. So he was earning crores of rupees. What he did, he purchased gold bricks, and he created some underground floor something, right? And in that, in some boxes, he kept all the gold. Now this suggestion was given by one of the goldsmiths nearby. One day what happened, the doctor, when he checked all the bags or boxes in which he kept the gold, all were empty. Nothing was there. Later on he came to know that the goldsmith who gave all these suggestions purchased a plot just beside the doctor's house. Then he did some digging of the ground inside, and he entered this place and he stole all the gold whatever doctor had. Now can doctor go to the police and complain? Because income tax department will ask this doctor to pay tax on the whole income, which he don't have now. So he cannot even go to police station to complain, right? Nor catch this goldsmith. So are you able to understand which type of repercussions if the income is undisclosed? If it is legal income, if it is disclosed, then you will pay some amount of tax, you contribute to the development of the nation, and you will have protection from the government in case any problem occurs also. Okay, so with this we'll complete the lecture. Hope you enjoyed it, I feel, right? And we'll meet in the next lecture. Till then, take care. Bye everybody.